Wall Street's dangerous new obsession with farmland. The auction yard is silent except for the wind rustling through dry corn stalks. Mark Davis stands with his father, boots coated in the same soil their family has worked for nearly a century. Across the field, a man in a tailored suit raises his hand. Another bid, then another. The number climbs past what any working farmer could ever afford. Mark's father lowers his head, years of sweat, gone with one wave of a pen. The winning bid doesn't come from another farmer. It comes from a corporate investment firm. That firm doesn't plan to plant anything. They plan to hold the deed. For them, this land isn't about food, it's about yield. To understand how farmland became a financial asset, we need to rewind. After the 2008 financial crisis, Wall Street went looking for safety. Stocks had crashed, housing imploded, and investors wanted something that couldn't vanish on a spreadsheet. They found it under their feet: soil. Productive farmland, they realized, doesn't go bankrupt. People will always need to eat. Farmland quietly transformed from a livelihood into an asset class. Institutions began buying thousands of acres at a time. Pension funds, billionaire investors, even universities. They called it diversification. But for farmers like Mark, it meant being priced out of the only life they knew. Here's the unsettling part. What happened to housing is now happening to food. Homes became securities in the 200s. Loans were bundled, sold, and leveraged until the system collapsed. Now, investors are packaging land itself, turning fields into financial products that trade on Wall Street. When farmland becomes a spreadsheet entry, it changes what the land is for. The goal shifts from feeding families to pleasing shareholders. And just like housing, the prices don't stay tethered to reality. Farmland that once sold for $3,000 an acre can now go for over $10,000, even when crop prices haven't risen. Farmers accustomed to handshakes and family legacies now face portfolio managers chasing returns. It's not that agriculture suddenly became more productive. It's that money decided it belonged there. Firms pitch farmland as a safe hedge, uncorrelated with the stock market. Real estate trusts lease land back to farmers, turning them into tenants on what used to be their own property. The pitch is clean, modern, and data-backed. Yet beneath all the spreadsheets is the same story that's played out across American capitalism. When necessity meets speculation, the necessities lose. Housing showed that pattern. Food follows next. To grasp how powerful this shift is, consider who's buying. The list reads like a roll call of global capital, BlackRock, TIAA, and the world's wealthiest private investors. Among them, Bill Gates, now the largest private farmland owner in the United States. His portfolio spans more than 240,000 acres across 19 states. Cascade Investment, his financial arm, made a $520 million deal to acquire a farmland REIT in 2017. It wasn't about becoming a farmer. It was about owning an asset that never goes out of style. Meanwhile, financial blogs and investment platforms praise farmland returns: steady, inflation-resistant, and reliable as gold. Farmland used to be a calling. Now it's a trend. Old barns rot while new financial products promise exclusive access to agricultural alpha. That language doesn't speak to planting seasons or irrigation. It speaks the language of finance: yield curves, cap rates, liquidity. Words that make sense in boardrooms, not in pastures. Yet decisions made in those boardrooms now decide who eats, who farms, and who gets priced out. The stakes couldn't be higher. Whoever controls the food supply controls the price of life itself. We've already turned houses into speculative tokens. Now, the same experiment is expanding to farms, with lessons unlearned and consequences unseen. So here's the central question this story will ask. How did Wall Street transform farmland into its newest gold rush? And what happens when the last farmers standing are answering not to the soil, but to shareholders? That day, standing by the fence, Mark Davis didn't lose just land. He lost the thing that grounded his family for 4 generations. As the corporate rep signed the deed, Mark's father said softly, "It's not our farm anymore." No one realized back then it wasn't just his family's story. It was a glimpse of America's next financial frontier, where the commodity isn't crops or houses. It's the ground beneath both. The great land grab. The story really starts after everything else fell apart. When the financial markets crashed in 2008, investors got burned. The housing bubble had popped, stocks were in freefall, and the safe bets suddenly weren't safe anymore. But one thing still stood quietly strong through the chaos: farmland. While portfolios evaporated and mortgages collapsed, the value of soil held steady. People still needed to eat, crops still grew. That stability caught Wall Street's eye. At first, farmland looked like a backup plan, a low-risk refuge for shaken investors. But the idea spread fast. Major institutional players started to connect the dots. Here was an asset that produced consistent returns, moved opposite the stock market, and could hedge against inflation. The logic was simple. Every day, billions of people ate food. Those calories started somewhere, and whoever owned the land beneath, that process owned the foundation of the entire economic chain. So starting around 2009, the land rush began. Firms that used to trade derivatives turned their attention to corn, wheat, and soybeans, not by growing them, but by buying the dirt they grew in. Pension giants like TIAA created farmland funds worth billions. Private equity groups and insurance firms built sprawling portfolios. By 2014, institutional investors managed tens of billions of dollars in farmland assets worldwide. The timing wasn't accidental. As central banks pumped money into the economy, cheap borrowing inflated asset prices across the board. Those easy loans trickled into rural America, where investors could leverage debt to buy large tracts of farmland. A pension fund in New York could suddenly outbid a fifth-generation farmer in Iowa without ever leaving their office. And that's exactly what happened. Local auctions that once drew neighboring families began filling with financial representatives. Unknown bidders dialed in remotely, pushing up prices beyond anything linked to actual crop revenue. Land that had stayed in a family for generations sold off in an afternoon. To the funds, it was a sound diversification play. To the people living off the soil, it was dispossession by spreadsheet. BlackRock, the world's largest asset manager, started analyzing farmland as part of its real assets division. Hedge funds like Man Group rolled out dedicated agricultural strategies. Investment platforms cropped up, promising everyday investors the chance to own a piece of American agriculture through fractional shares. Everything about farmland, not just its produce, but the soil itself, was being financialized. Meanwhile, prices began to skyrocket. The average cost of North American farmland doubled between 2008 and 2022. In some regions, it tripled. Small farmers used to gauge land value by yield, how much wheat or corn it could grow. Financial buyers calculated it based on return percentages, discount rates, and inflation projections. The metrics diverged, and suddenly the market did too. That's when independent farmers began to disappear from the bidding tables. They couldn't compete with funds promising 8 to 12% annualized returns. Each sale tilted the scale further. When neighbors sold, local economies shifted. Rural banks saw loan demand fall as family farms vanished. Seed and feed stores lost customers. Entire towns started to feel the emptiness. The land itself changed hands quietly, often through shell companies or limited partnerships that disguised true ownership. One tract might be held by Prairie Investments LLC, another by Harvest Acquisitions II, but they all linked back to the same financial pipeline. By the mid-200s, foreign investors joined in. Sovereign wealth funds from the Middle East and Asia began purchasing U.S. acreage as a geopolitical hedge. To them, farmland wasn't part of a national identity. It was exposure to food inflation protection. Farm economists at universities tried to warn about what they called asset detachment, the widening gap between farmland's productive value and its traded price. But warnings were easy to ignore because on paper, everyone looked richer. Counties posted record land valuations. Tax revenues climbed. Politicians praised investment in rural America. Few stopped to ask whether those investors would ever plant a seed. In this environment, figures like Bill Gates stood out not because they started the trend, but because they personified it. Gates's Cascade investment quietly rolled up over 240,000 acres of farmland, structured through dozens of LLCs. The media fixated on him, but his presence only highlighted a broader shift. Farmland had become the new Silicon Valley, promising steady returns instead of disruptive innovation. Even if the crops failed, the land's long-term scarcity guaranteed appreciation. What no one planned for was what these transactions did to the next generation of farmers. Young people raised on farms already faced tight margins and tough access to credit. Now they were priced out entirely. The American Farmland Trust estimates that nearly 40% of farmland will change hands within the next 2 decades, but fewer and fewer of those new owners will be actual farmers. Most will be institutions. Each purchase also concentrated power. Where once ownership was scattered among hundreds of local families, now a handful of trusts and asset managers hold millions of acres. Farm policy, crop choice, and even soil management increasingly respond to investor expectations rather than community needs. An analyst in a New York office weighs water use and fertilizer costs the same way they might analyze risk in an office REIT. Underneath all of this ran another insight investors couldn't ignore. Farmland wasn't just dirt, it was water. Many state water allocations are tied directly to land ownership. When a Wall Street firm buys acres in Arizona or California, it gains control over the aquifers beneath them. That control can be more valuable than the crops the land can grow. With drought tightening its grip on the West, investors realized water rights could appreciate even faster than real estate. As a result, speculation in arid regions surged. Firms began to describe water as blue gold, emphasizing its scarcity value in earnings calls. Private equity groups funded water management companies that served as intermediaries, allowing investors to acquire acreage primarily for the attached rights. Once that connection clicked, the line between farmland and finance blurred completely. The field itself became a financial instrument. For farmers, all this meant new kinds of landlords. Instead of neighboring families or local cooperatives, they now answered to fund managers tracking quarterly returns. Lease contracts included clauses about minimum yields and technological adoption. If profits slipped, the land could be sold, subdivided, or repurposed for solar leases. Farming became a temporary occupation in service of permanent asset management. And yet, to outsiders, it looked like prosperity. Reporters noted rising land values as proof of rural revival. Real estate agents celebrated multi-million-dollar auctions. Investors boasted that their farmland portfolios had never lost money in over a century. But the story on the ground was the opposite: consolidation, rising barriers to entry, and an ever-shrinking group of actual producers. By the end of the 200s, institutional landlords controlled millions of acres across the Midwest, the Delta, and the West. Wall Street had successfully colonized the countryside. Fields once passed down through families were now investment vehicles, strategic holdings in a global portfolio mix. It was the great land grab, and it was only the beginning. The shift might have ended there if farmland were just soil. But as investors soon discovered, the real treasure lay beneath the surface. Because whoever owns the land doesn't just control what grows on it, they control what flows through it. And that realization would carry this story into an even higher stakes arena: water. The water connection. It starts with a fact most people don't realize. Owning farmland isn't just about the surface. In much of the United States, when you buy land, you're also buying the rights to the water underneath or flowing through it. That invisible asset, water, is what transforms farmland from a simple investment into a strategic weapon. In the past, farmers and communities used and shared their water locally. But once Wall Street discovered that water rights could be monetized, the ground itself became a vessel for financial leverage. In places like Arizona, California, and Colorado, the value of an acre is now determined less by what can be grown on it and more by what flows beneath it. When hedge funds began purchasing farmland in these regions, they quickly learned that an acre with secure water rights could be worth several times more than one without. That realization triggered a quiet but powerful shift in motivation. Investors weren't just buying earth, they were buying access to something that's becoming scarcer every year. Take the American Southwest. It's in the midst of the worst megadrought in 1,200 years. Farmers who once relied on steady irrigation from aquifers now see wells drying up. Yet, many of those same aquifers are being tapped by corporate farms or absentee owners trying to maximize short-term yields. Deep wells, powerful pumps, and massive water withdrawals move irrigation water miles away from communities that have depended on the same water sources for generations. In Arizona's La Paz County, residents watched quietly as out-of-state investment funds began buying large tracts of farmland. At first, it seemed harmless, just another real estate transaction. But soon, drilling rigs appeared, boring thousands of feet down to tap the valley's groundwater. Within a few seasons, the water table dropped, and family wells began to run dry. Some farmers had to deepen their wells at enormous cost. Others abandoned their fields altogether. When local officials asked the new corporate owners to adjust usage, they were told everything was completely legal. And it was. That's because water rights law in the western United States was built around a doctrine called first in time, first in right. Whoever first claimed the water decades ago and attached it to land deeds still controls it today, regardless of modern ecological realities. Investors exploited this relic of the 19th century, buying up land with senior water rights and diverting those resources to where they could earn the highest financial return. Sometimes that meant selling water to nearby cities or bottling companies instead of using it to grow food. In those transactions, the crops were incidental. The water itself was the real harvest. Michael Burry, the investor famous for predicting the 2008 housing crash, was among the first to understand this. After shorting subprime mortgages, he turned his attention to agriculture, but not for the crops. He bought farmland with strong water rights, calling them the purest way to invest in water. His strategy spoke volumes about the direction the market was heading. He wasn't alone. BlackRock, TIAA, and other investment giants started flagging water sustainability as a core investment theme. Water Asset Management, a New York-based fund, spent over $100 million buying Arizona farmland specifically to secure its groundwater rights. Locals called it a water grab. As these purchases accumulated, something fundamental changed in the balance of rural power. Control over water once rested in the hands of local irrigation districts, small communities, and state agencies meant to balance competing needs. Now, some of that control has shifted to private investment firms whose fiduciary duty is to maximize returns, not to preserve resources. When you treat water as a financial asset, conservation becomes a secondary concern. The problem isn't confined to the desert. In California's Central Valley, industrial almond and pistachio orchards financed by corporate capital dominate landscapes that use to support diverse crops. Those orchards draw billions of gallons of water annually, often from dwindling aquifers. Because tree crops require watering every year once planted, farmers can't simply fallow fields when water shortages hit. Investors know this, and many use debt restructuring to squeeze every bit of production out of the land until the aquifers are empty. When the wells run dry, they move on. Meanwhile, small farmers are stuck fighting for what's left. Consider the story of the Romeros, a third-generation family in Kern County. For decades, they irrigated 120 acres with well water that had sustained their almonds and grapes. But after corporate farms bought thousands of acres nearby, drilling deeper and faster, their wells started coughing up sand. Within 2 years, their aquifer level had fallen by more than 100 feet. The Romeros tried to dig deeper, but between drilling costs and rising electricity prices, they couldn't keep up. Eventually, they sold the land, ironically, to one of the very companies that drained them. Across the West, local residents have watched a new kind of speculation unfold. Water rights, once tied to the public interest, are being treated like tradable commodities. In some states, opaque water markets allow owners to lease or sell their rights independently of the land. It's perfectly legal for an investment fund holding agricultural water rights to transfer that water to municipalities or industrial users miles away. Each transfer can yield profits without planting a single seed. That's how farmland becomes a front for something far more valuable: liquid capital disguised as soil. Regulatory loopholes make this possible. Federal law barely touches groundwater allocation. State-level oversight often relies on outdated data or voluntary reporting. This leaves space for speculative trading of resources that entire communities depend on. The legal framework can't keep up with financial innovation. What started as a hedge against inflation is now reshaping the geography of water itself. And there's an even deeper irony. As investors boast of sustainability and green portfolios, many of their holdings actively worsen resource depletion. Corporate-led farms deploy sensor networks and algorithmic irrigation aimed at efficiency. But efficiency in this context usually means wringing the maximum short-term yield from a constrained aquifer.